Everyone, welcome to the IMIM seminar today. We're happy to host Mikhail, Mike Chernov, who is a professor of finance and Warren Corner Chair in Money and Financial Markets at UCLA Anderson. Mike's research sits at the intersection between macrofinance, asset pricing, including like derivatives, fixed income, currencies, and also joining this financial econometrics. His work include many influential papers such as jump risk, term structure, inflation expectations, and CIP deviations. One thing that inspires me most from Mike's work is how he extracts and distills the economic insights and meanings from these asset prices from the econometrician's perspective. So using these econometrics techniques while extracting these economic values out of these asset pricing dynamics. So please join me in welcoming Mike Chernov. And we're also pleased to have Elias Filippo as our discussant today. Elias is an assistant professor of finance at the Florida State University. His research are mostly focusing on currency risk premia, but also includes asset pricing and using machine learning techniques in solving complex asset pricing problems. So we have met just a couple of weeks ago at FMA. I was discussing his very recent work in how he used systematic risk, systematic components in the subjective expectations to price these different currencies. So also welcome Elias joining our discussion. So today Mike is going to talk about his paper, Reassessing Sources of Risk Premiums in Currency Markets. Mike, you have 45 minutes.
Great. Thanks a lot. Thanks for your kind introduction. I'm looking forward to your feedback. Feel free to interrupt me at any point. I might not see a raised hand, so don't be polite. Just interrupt me whenever you want to ask a question. All right. So this is joint work with my longtime co-authors, Magnus Dahlquist and Lars Lokster. And so this paper is motivated basically by a figure like this, and I'm sure many of you have seen this before. This is performance of the famous carry strategy, and this picture shows cumulative performance. We have this notation G, which refers to G10 currencies. And so, of course, this is a well-studied strategy, and it's, I think, pretty well known that it basically started underperforming roughly after the 2008 crisis. And kind of separately, there is a sort of big literature that calls for considering emerging country currencies as part of portfolio strategies. And so, in fact, if we look at specifically at the carry strategy, there is a dramatic difference in performance. So if we start, so our data set on a broader set of currencies starts in 96. So if we include all the currencies that we have into carry strategy, so we get a much more dramatic performance. So basically, carry continues to improve. It's basically almost a linear relationship that continues after specifically continues after the 2008 crisis. And so basically, this picture is asking the question of what's going on. So that's what we're trying to figure out. And so the first question is, well, what does it mean in scientific terms? What does it mean? What's going on? And so basically what we're trying to do is we're trying to capture risk-return trade-off in currency markets. And in particular, want to focus on changing dynamics in this trade-off because it seems like something has changed after the 2008. And given that the change is related to regional differences in currencies, right, G10 versus a more extended data set, I would like to also to understand the role of different regions in this return trade-off. And one has, if you kind of want to think about questions like this, you have at least two sets of tools that we have in the literature. One is you can think about building an equilibrium model, which my personal opinion is that in this kind of setting, it's almost hopeless. We have some nice equilibrium models, but I think they cannot really address in all realism that sort of this kind of broad behavior across different in a wide cross section of currencies. Or we can think about, we can be sort of more parsimonious, maybe less economically insightful, but trying to think about a factor structure of risk and returns, expected returns, and try to understand from that perspective. So that would be like a classic cross-sectional pricing approach, and that's basically what we're going to do in this paper. And so to fix ideas, let's think about, so we have here excess returns on a currency I. I have a tilde here. Tilde basically indicates innovation, so we're taking out conditional mean. And so we can broadly, it's a generic, there's nothing deep here. We can generically think about representing this excess returns in terms of a combination of three components. One is going to be priced risk captured by potentially multiple factors F. Then there is going to be unpriced risk, but risk that's common to different currencies. And finally, there's going to be currency-specific risk or idiosyncratic risk. And so if I want to think about risk-return trade-off, I basically need to isolate this set of factors F, because that's what's responsible for pricing in the situation. And so one way to think about how do I isolate these factors is that we want to construct a portfolio that tracks these factors. So if we can do this, if we basically have a portfolio that behaves like F, proportional to F, then we can think about basically writing is equivalent to representing a stochastic discount factor as, again, a linear transformation of this factor. You can, again, here tilde indicates innovation. Okay, so that's broadly speaking what one should be after. And so we have a decades-old theoretical solution to this problem, which is mean variance efficient portfolio. So specifically, we will want to focus on unconditional mean variance efficient portfolio. And so this is a portfolio that maximizes unconditional Sharpe ratio. And so we have a closed form solution for portfolio weights with it. So if I have a whole vector of currency excess returns, basically if I multiply them by these weights, I will recover this mean variance efficient portfolio. And it basically has two components. One is a kind of very familiar expression, sigma inverse times mu, which is a conditional mean variance efficient portfolio. So that's portfolio that maximizes conditional Sharpe ratio. And so there's infinite amount of those portfolios, right? We can scale this guy by any constant or by any variable known at time t, and it's still going to be a conditional maximal Sharpe ratio, okay? And so unconditional maximal Sharpe ratio is a particular choice of leverage, which is controlled by this variable, which is basically 1 divided by 1 plus maximal Sharpe ratio squared here. Okay, so that gives us portfolio that, in addition to maximizing conditional Sharpe ratio, is also maximizing unconditional Sharpe ratio. And so on the next slide, I'll describe why this distinction is important. Okay, but the key is that whatever you're thinking about, either MVE, you basically have two critical inputs. So you have to estimate conditional mean excess return, and you also have to estimate conditional covariance matrix. And so then you will be able to construct this optimal portfolio in a kind of standard way. All right, so suppose we have this portfolio, what does it give us? So again, going back to conditional, first looking at the conditional mean variance efficient portfolio, so basically something that's proportional to these guys. It satisfies a linear pricing model. Okay, so meaning that conditional expectation of a return, excess return on any portfolio is going to be conditional beta times conditional expectation of the return on this portfolio, right? So here we have conditional beta, that's kind of standard stuff. So the problem with this conditional is kind of nice algebra, but the problem with conditional linear pricing model is that it's hard to implement in practice because it's hard for us to measure in a model-free way, hard for us to measure conditional expectations. So again, the standard trick is to say, okay, let's take unconditional expectation of this expression, and run with sample averages, basically. The problem, and this is first pointed out in this paper by Jonathan and Wang, is that once you start taking unconditional expectations, you have two random variables here. So we also have their covariance showing up. And so we don't really, it doesn't really simplify our life. We have to think, again, we have to think about basically modeling these conditional objects to figure out this covariance. But if we look at a specific version of conditional mean variance efficient portfolio, which is unconditional mean variance efficient portfolio, it actually satisfies also unconditional linear pricing model. So here we have unconditional expectations, and this is unconditional beta. Okay, so this is basically one specific case of general mean variance efficient portfolios that basically loses this covariance term. So this is much easier to test. Okay, so the problem with this is that ideally we'd like to have, of course, we want to have correct conditional asset pricing, right? We want to price assets correctly every day as opposed to just on average in our sample. So a result from Hansen, one of the results from Hansen and Richard is that if this equation is satisfied for all feasible test assets, then it also implies correct conditional pricing. So of course we cannot literally look at all possible portfolios as test assets, but it kind of gives us an idea that if we look at a sufficient amount of these portfolios, we will also establish conditional pricing. So basically that's kind of a formula that we can, or equation that we can work with to implement this. Okay, and so it's also, the nice thing is that we have a standard JRS test, Gibbons-Ross-Schenken, that allows us, so it's a kind of a time series test of cross-sectional asset pricing. So we can implement basic OLS regressions and test whether alphas are equal to 0 in this relationship.
Mike, I have two questions. So first, like, how do we think about this unconditional MVE? Like, because when we construct the weight of this UMV portfolio, essentially it was peer by peer. So it is still conditioning on information, right? It's not a unconditional. It's
the language,
leveraged.
So it just, so this kind of semantic confusion is not our language, it's in the literature, right? So the reason it's called unconditional because it maximizes unconditional Sharpe ratio in addition to maximizing conditional Sharpe ratio, right? So again, if we look at this, if we look at this equation, right, all the portfolios of this form that are proportional to this, they will maximize conditional Sharpe ratio. So in particular, with this specific choice of leverage, this still maximizes conditional Sharpe ratio.
It's a bigger portfolio.
Yeah, but it also maximizes unconditional. So it's a kind of, it's a bigger concept than, so usually we think unconditional is something that's kind of like more limited, but in this case, it's the other way around. So it's totally, absolutely, it's conditional portfolio. It's changed portfolio weights will be changing every period. It maximizes both conditional and unconditional Sharpe ratios. And as a result, it satisfies, this is the only portfolio that satisfies this equation. It satisfies this equation as well, of course. But on top of that,
so with that construction, you make this beta a constant instead of a time varying. Is that true?
Well, it's unconditional beta. See, it's just we're using unconditional covariance and unconditional variance to compute the beta, as opposed to here where you have to use conditional covariance and conditional variance. So it's a different beta. But again, UMV satisfies this equation as well. So that's why, again, it's a more general concept. But this is hard to test. In general, it's hard to test, but uniquely, it also satisfies this equation. So this language confuses a lot of people. I don't know how to undo it because it's not my language. Okay, so basically, once we settle, if we implement this portfolio, we can estimate these equations and test them by GRS. And if we look at a bunch of different portfolios, we get more confidence that actually it also leads to conditional pricing. So how is this related to the kind of standard approach in the literature? The standard approach in the literature is to use characteristic-based portfolios. This goes back to Pharma French, and this goes from the equity literature. Okay, so basically saying, okay, let's form portfolios based on some characteristics that we think are related to expected returns. So some characteristic X. Okay, so in the context of currencies, it could be the characteristic could be interest rate differential for the carry strategy, maybe prior risk returns for momentum, real exchange rate for value. Okay, so then we'll say, okay, we will go long currencies with high value of this characteristic and short currencies with low value of this characteristic. Okay, so the problem with this approach is that we're contaminating factors with unpriced risk. By doing this approach, we're introducing unpriced risks into something that should be just our priced risk. So again, if we think about this representation that I started with, right? So on top of the factors that we're interested in, we will be bringing also unpriced factors. So let me illustrate this with a very simple example. Okay, so here I have two currencies, I and J, and this is their true factor structure of returns. Okay, so I has a exposure of half to the priced factor, an exposure of mine, and the second one has an exposure of minus a half to the second factor, and both of them have some sort of exposure to the unpriced factor. Okay, so for simplicity, these factors are ID, and so F is priced in the sense that its expected excess return is equal to 1, and U is unpriced in the sense that its expected excess return is equal to 0. So let's define a characteristic as a loading on F. So in the first case, the characteristic is equal to a half. In the second case, it's equal to minus a half. So I'm gonna buy portfolio with a high value of characteristic and short portfolio with a low value of characteristic. So this is going to be my characteristic-based portfolio. And so what does it recover? It recovers F, but also it recovers a certain exposure to U. So there's going to be no exposure to U, only if the two betas are the same. If they're different, we'll also have some exposure to U. Okay, and so what basically happens here is that by having U here, we're increasing variance of the factor without increasing its expected return, because expected return is just coming from here. This guy expectation of this is equal to 0. So we're basically getting a Sharpe ratio that's lower than it could have been if we didn't have U. Okay,
So yeah, so I also like think a little bit like more about this, like how, because this is very relevant to our work with Nick. Like, how do we think about this like unpriced risk? If we think about it SDF, we have some covariation in returns. Why didn't they didn't have like a positive risk premium for these risks?
Yeah, so I'll get to this if I have time. I have slides on this at the very end of my talk.
Okay.
But we sort of, yeah, a lot of people asking us this question. But in general, there is nothing wrong about this, right? We're basically saying, if you think about this in the context of excess returns, you have exposure to some price risk and some unpriced risk. And unpriced risk, there could be common variation, right? Unpriced risk doesn't have to be idiosyncratic risk like currency specific. It could be affecting multiple currencies at the same time. Jumping ahead, like for example, in our case, we seem to find connection to geographic allocation. So,
But aren't they systematic in some sense?
well, they're systematic in the sense that they're common.
Yeah, they're
right, but they're not priced. They don't have to be priced. For example, in equities, industry risks are not priced. They're common, but they're not priced. And kind of in equities, people are fine with this. So it's this kind of similar situation. All right. And so here's an example. So now if I construct MVE using the formula that I showed you earlier, so I use expected return, I construct covariance matrix, and I do sigma inverse times mu. I get this weights beta j and minus beta I. And so if I do this with my returns, I will recover something that's proportional just to the priced risk. Okay. So basically, in this example, we are recovering this whole thing. And so more generally, when we're forming characteristic-based portfolios, I mean, maybe it's hard to say ex ante, but there is this basically risk that we're introducing this unpriced risk into our characteristic-based portfolios. And if we do, it kind of contaminates how we think about risk premiums and how they are formed. Okay, and so again, it's an empirical question to figure out how much of this we're introducing. So there is a paper, reasonably well-known paper by Daniel Motta, Rodke, and Santos, who recognize this problem in the context of equities. And they basically propose to construct, instead of characteristic-based portfolios, they call them characteristic-efficient portfolios. So basically, the idea is the same, trying to kind of fight introduction of use, basically trying to hedge them out from original characteristic-based factors. And so this is a formula for their characteristic-efficient portfolios. And what's notable here is that they feature inverse of the covariance matrix of returns. And it's kind of more implicit, but this construction is based on the assumption that expected returns are proportional to characteristics. So basically, in order to implement this characteristic efficient portfolios, you sort of need roughly the same thing. You need to implement MVE itself, because you need to know covariance matrix, and you need to know how expected returns look like. At least you have to know that they are proportional to these characteristics. So basically, ultimately, if we want to get rid of U, we have to grapple with the same problem that we need to know covariance matrix and to know something about returns. And so what we have established in our previous paper with Magnus and Lars is that specifically for currencies, we can explicitly construct conditional expectations and covariance matrices for currencies. Because in contrast to equities, there are very few of them. That's number one, right? So for example, in our previous paper, we just had 9 exchange rates versus the dollars. Here we have about 60 exchange rates versus the dollars. This is a drop in the bucket compared to, I don't know, 12,000 equities in just in the US stock market. So that allows us to construct covariance matrix, and basically it doesn't matter. There are a ton of different methods how to do it, because the cross-section is so small, basically any method will do. And the second thing is that what we're discovering is that although people argue about this all the time, whether currencies are predicted well or not, and one view is that it's actually very hard to predict currencies, but relative to equities, they're much more predictable. Okay, so it's a relative statement, but it's much easier to predict them at least relative to equities. So in particular, we're using 3 signals to predict. So this effectively, you can think about these 3 characteristics that are required here in this context, right? So we're basically saying that interest rate differential here measured with forward rates. Then we have mean reversion signal, which is captured by the real exchange rate. And then we have a trend that's captured by 1-year change in the exchange rate. And so we're basically saying we're predicting returns, currency returns using these 3 characteristics. And we're sort of doing this in a panel context, right? So you can see that coefficient here, we're setting coefficient to 1, and these 2 coefficients are not dependent on the specific currency. So we're estimating this in a panel, and then we have a subscript T just to emphasize that we are at each point in time t, we're just using information up to time t to estimate this. So every period, we're estimating this panel to update these coefficients. All right, so this is basically so we're kind of saying this is how we'll be estimating expected returns, and we will use daily data to estimate covariance matrix. So it's basically some variation on realized covariance. So again, something very simple and basic.
Mike, can you use let's say, can you use directly the return instead? Why do we need characteristics managed portfolio here? Because we need for equities, because equities are thousands of them.
No, we're not using characteristic. We're constructing UMV, right? So for UMV, we need this 2. I'm literally using this formula that I showed you earlier. We're implementing this formula. We need 2 inputs. And that's what we're doing every month. We're computing.
But can we use just the return of the currency without any conditioning information? So let's say I just have a daily return for Japanese yen, and I calculate a conditional covariance matrix rolling 30 days.
Yeah, exactly. So we're doing. So we will have for example 10 or 60 exchange rates.
Mm-hmm.
And so we'll compute basically sample covariance matrix using daily data within a month.
That's at the asset level. Well, for the conditional mean excess return, you're using the characteristics to predict the excess return.
Yeah, well, because we need expectation, right? We need expectation of return. How do you form expectation of return? You need some predictors, right? We just kind of said we kind of looked at the literature. We're citing some papers like from the 60s and 70s. We kind of say, look, people looked at the signals for a long time, so it kind of turned out to be much easier than we expected, to be honest. We kind of said, okay, these are 3 reasonable variables to look at, and that was enough.
I see.
So sometimes
because I thought you can use like just the monthly return this month.
You know, like from the past, to predict RT, you use RT -1.
Yeah, something
Oh
like
yeah,
that.
no, but they are too noisy. You can do it.
I see.
Also, yeah, I also have a related question. For the conditional mean, did you also try maybe to use additional predictors, not only those 3? I'm saying that because for potential, circularity concerns, in the sense that later you try to price these factors, like carry momentum. So whether you could add more predictors so as to basically guard against this issue. You see what I'm saying, right? Because later you're going to price carry momentum and value. So I was wondering whether
Right, but
you could add more predictors. Yeah.
Right, but because of covariance matrix, right? Because we're weighting this muse by covariance matrix, you're getting very different object than characteristic-based factors. So it's not regressing Y on Y. Right, that's exactly my simple example, right? Because this is this thing, right? If you do that's basically characteristic-based portfolio when we're basically ignoring effect of the covariance matrix. And that's what you get if you're accounting for covariance matrix. So these are different animals.
I see. Mm-hmm.
Right. So there's no mechanical relationship. And yeah, people ask us a lot about this in this context, but also people in general saying, oh, maybe you can predict better when you add more variables, which could be true. But like we're already failing to reject our model in our tests. So we need some sort of a moment in the data that would reject our model so that we could improve it, because we cannot improve it if we're already failing to reject it. So that's why we stopped. That's why we stopped at this. We kind of showed again in our previous paper, we showed that if you just do basically random walk kind of thing, which is also natural starting point, then you reject this. So by itself, random walk is not going to do it. And then we didn't do separately one or the other, but when we add both of them, mean reversion and trend signals, you no longer reject the model. Okay, so let me preview if I run out of time, right? So basically, if we take this mean variance efficient portfolio formula implemented as I just described, we basically show that this portfolio prices all currency strategies, both conditionally and unconditionally. So specifically, the set of currencies that explains portfolios across all, so again, we're looking roughly at 60 countries. Actually, the set that explains everything contains only 21 currencies. So it's going to be G10, so it's going to be 9 exchange rates versus the dollar, plus 12 what we call floating emerging currencies, meaning that you have these would be outside of G10, but they're reasonably, again, there's like a whole smoothness between what you call floating and not, but they're kind of more floating than others. Well, the least pegged, that's another way to call them. And again, our choice of 59 is primarily based on the availability of forward contracts. And so then what we do is that we look at the various famous strategy returns like carry and also, of course, momentum and value. And because we have this mean variance efficient portfolio, which is basically proportional to that F, to the price factor, we can decompose each strategy into the price component and unpriced component. And so we can measure how much of unpriced stuff is sitting in those famous strategies. So it turns out that the amount of unpriced risk is very large. So it's at least 70% of variation in this kind of famous strategies. And so what it means is that if you hedge out this unpriced risk, you should improve Sharpe ratios of those strategies. And that's what we find, because given that we have this real-time mean variance efficient portfolio, we can also construct real-time hedge ratio. And so when we hedge out on price risks, the strategies behave much better. And so then we're kind of trying to understand if we can label this price and non-price risks. And so what we're finding is that there is some connection between price components of the strategies and long-run US consumption betas, and non-price risk are related to geographic factors. But there is more things to do in this dimension. Okay, so what's our data? So basically we have from 97 to 23, we have this database from DataStream WMR. So we have this 59 spot and forward exchange rates. And then for G10, we also have data going back to 1985 for forwards and even earlier for the spot exchange rates. Okay, and so we use US dollars, both base and measurement currency. So everything is expressed in terms of dollars, but also if for example, you have some sort of a strategy that requires some reference currency, that's base, we always use US, because the evidence in the literature is that using US dollars as a base is particularly advantageous for the strategies. Okay, so then we split our currencies basically into three groups. So one is this G10 that I already mentioned. So this is basically this set. And then what we call floating emerging, or whatever the least pegged countries, and this is based on classification in this paper. Okay, so then everything else, we'll have everything else, and so the remaining currencies are much closer to pegged. And so the main reason why we're trying to separate into these different groups is because when currencies are literally pegged to the dollar, right, then of course properties of strategies are changing, right? Because you basically, for example, if you're thinking about a carry, you're trading dollar versus the dollar, but so there is interest rate differential is coming basically from credit risk, which is sort of very different thing than sort of a classic carry strategy. And so also it affects volatility of the portfolios, because again, taking an example of literally pegged currency, it contributes nothing to variation in the bunch. So it kind of requires different philosophy in terms of thinking about them. So we separate these guys into a separate group. Okay, and so these are the trading strategies that we're looking at. Again, all the famous strategies, dollar carry. So we have three different carries, 4 different momentums, and 1 value. So this, again, historically, the strategies seem to produce the higher Sharpe ratio, so they're kind of the most interesting to look at and understand. And so when I start talking about various tests, so we have 3 different groups of currencies, and so we're implementing this for 3 different groups. So we doing either G10 only or G plus GE, so then it's going to be 21 currencies, or we're doing this on the whole set. So for example, when we say GX, if I'm reporting results for GX, it means that I'm testing carry constructed from the whole thing. All right, and so this is just illustration of how the strategies are performing. And so if for example, look at this chart, I already almost showed you everything, right? So that's carry. And so again, the red line is a G10, which flattens out. The green line when we're using all of them, GEX. And then the middle one is when we're using this combination of G10 and some of this floating currencies. Okay, and so as you can see, there is kind of differences in performances, right? If you look at the dollar strategy seems to be kind of similar regardless of what you do with these currencies. But there is also some spread when we look at momentum, although even full thing levels off eventually. And then also there is some spread when we're looking at value. Okay, in the paper, we're reporting kind of more details on this. So let's look at some results, right? So first, we're basically saying, okay, we're constructing this mean variance efficient portfolio. Well, how much? So the theory tells us that if I want to price a set of n currencies, I need to construct mean variance portfolio from these n currencies. Empirically, it could be different. Empirically, it could be the case that a smaller set can price a larger set. So the question is, how small should this pricing set be? And so here's basically this table shows an example of the tests of the type of the results that we're reporting in the paper. So here, what I'm doing is that I am constructing strategies from this intermediate G set, so 21 currencies. And I'm also constructing UMV from the same set. And so I'm asking, well, can this UMV price all these 10 different or 9 different strategies that we're looking at? Right, and so basically here I'm listing all the strategies and their respective Sharpe ratios, sample means, and t-stats. So many of their means are significant, Sharpe ratios are quite large. We also, as a reference point, we are reporting another strategy, which is 1/n of these 9 strategies. It has even a higher Sharpe ratio. And so it has an alpha with respect to our candidate mean variance efficient portfolio. And these alphas, all of these alphas are insignificant. Okay, so that's basically looking at them individually, and then there is a GRS test that combines them together, and p-value is 0.5, right? So we're basically failing to reject that our candidate UMV portfolio can price these things. And so in the paper, we also show that if we use a smaller set of assets, if we use only G10 assets, we cannot price G, right? So we need, if we want to price these 21 currencies, we actually need all of them to construct UMV portfolio. Okay, another notable thing that we are reporting is that we're reporting here R squares from these regressions, right? So given that alphas are 0, R squared measures how much priced risk contributes to the overall variation in returns. Okay, so for example, for the dollar strategy, it says that basically almost everything is unpriced. Okay, if we look at cross-sectional carry strategy, we have 31% is price, so 69% is unpriced risk. So that's basically the way to read these R squares results. All right, so the next thing is that now we're kind of thinking, let's be more ambitious. So let's stick with the same UMV constructed from 21 currencies, but let's see if we can actually price the whole set of strategies constructed from the entire set of currencies. Again, here we're also introducing transaction costs, because as we start going into all these funky currencies, the bid-ask spreads are much wider. So basically pricing, we're only looking at proportional transaction costs. And so there's also debate in the literature because bid-ask spread reported in this data stream data set seems to be too large compared to effective bid-ask spreads. And so there is kind of debate in the literature what's the right amount of transaction costs that you have to think about. So we basically vary transaction costs from 0 to 100% of the reported bid-ask spread in a database. I think some papers are recommending to think about 50% to 25%. Okay, so basically what we're showing here is that we're showing maximal Sharpe ratio, and that's kind of the intuition behind Gibbons-Rose-Shankin test. We're kind of thinking, let's look at maximal Sharpe ratio of our UMV portfolio versus maximal Sharpe ratio constructed from the UMV portfolio and all the test portfolios. And so if UMV portfolio can price the test portfolios, then there's no significant difference between the two. Okay, and so basically we have here the asymptotic p-value is 0.05 right at the border. Bootstrap p-value is, so it's also known to over-reject. So 0.05. If we construct bootstrap p-value, it's 12%. Once we start introducing transaction costs, p-value starts growing. So on the one hand, it's kind of intuitive because we're kind of saying, well, we're looking at this test portfolios, there is some turnover. So as we increase how costly turnover is, of course, it's easier to explain these things. But we're simultaneously increasing turnover costs in our mean variance efficient portfolio. So it's actually extent, it's not obvious that this will work, but we are basically failing to reject a different cost level. Okay, so that's our kind of very interesting result. Again, theoretically, it doesn't have to be the case at all, but we have a smaller set of currencies that prices a wider set of currencies. All right, so I have 5 minutes left and maybe half of the slides. Okay, so let me move a little bit faster. So one thing, again, what I pointed out is that we're exploiting the fact that UMV portfolio also satisfies conditional pricing model, not just unconditional, but also conditional. And we can construct betas because this is how they look like. We basically have all the inputs. We have optimal portfolio weights. We already estimated covariance matrix. And of course, we know portfolio weights of the characteristic-based portfolios. So we can hedge out, we can basically construct, so this is unpriced component, which is basically the difference between return on the portfolio and the priced component. So we can throw out this unpriced risk and see what's going to happen with our portfolios, test portfolios. And this is broadly the picture, right? So again, I'm just, in the interest of time, I'm going to focus on cross-sectional carry. We're basically saying, okay, this is a Sharpe ratio of the original strategy, of the original carry. This is the Sharpe ratio of the hedged carry, okay? And so this is the Sharpe ratio of the unpriced component. It has to be 0, and it's empirically close to 0, okay? And also the reference point, this is the Sharpe ratio of the mean variance efficient portfolio. So theoretically, this should have the highest Sharpe ratio, and we see that for a couple of strategies, we're getting pretty close to that best kind of possible outcome. All right, and so this just shows, again, cumulative return. So if we do UMVE, it kind of dominates everything. And if we have a price component of the strategy, this is the blue line. It's kind of, depending on the strategy, it could get very close to what we get from the mean variance efficient portfolio. Okay, so this is basically highest returns that you can get. Okay, let me skip this. So another implication of what we do is that we can evaluate existing models of currency returns, basically alternative models. And we have one very famous benchmark, which is a dollar carry factor model. And we have both unconditional version of this model and conditional version of this model. So again, based on what we discussed with respect to UMVE, this is one and the same model, only if these two factors are spanning UMVE. If they don't, this is going to be two different models that one can test. Okay, so they don't have to be one and the same model if they don't span the UMVE. So to test this model, we can just run, again, like GRS, we can run regressions on dollar and carry and see what's going to happen. If we want to test conditional version of the model, we have to basically, sorry, here we go. We have to take out the factors exposed to conditional betas. Again, conditional betas we can compute because we have all the conditional objects. And then test if the remainder, which is alpha, basically, if alpha is equal to 0 or not. Okay. So these are the tests. So here we have a test of the unconditional dollar and carry. And we can see that basically all of the alphas are significant. And so GRS test gives us a p-value of 0, so we're rejecting unconditional dollar and carry. When we look at so this out of sample alpha, this is basically the conditional test where we basically hedge in real time and then testing whether the remaining alpha is equal to 0. Again, we basically, everything is significant, highly significant, and GRS rejects this as well. So we're rejecting both conditional and conditional versions. All right, so I have 1 minute left. So let me just quickly talk about the nature of these factors, right? So we're basically motivated by Daniel Motorotke and Santos, who relate on price risk to industry risks. We're kind of saying we want to see if geographic factors are going to be related to our price risk in the context of currencies. A paper by Lusig and Richmond saying that they contribute a lot to currency co-movement, and yet maybe there is no risk premium. And so we're basically creating a Europe versus the rest of the world factor. And so we find that actually they're lining up pretty well, not perfectly, but pretty well with our unpriced factors. So again, I'm going to skip some of the details. And lastly, we are trying to see if we can relate our price components to some macro fundamentals. And so the only variable that we could actually relate it to is going to be long-run consumption beta, which is like a three-year consumption beta in the spirit of Parker and Juilliard. And so the interesting thing here is that if we look at the overall strategy, and we kind of want to say if betas are different from each other, significantly different from each other in a cross-section, the p-value of this is 0.06, is kind of borderline. But if we isolate the price component of strategies, and then we look at betas there, then there is a clear spread. So we're basically failing to reject the null that these betas are similar. And if we look only at unpriced components of the strategy, then p-value is gigantic. So again, it's very important to separate and to look only at the price components of the strategy, so then connection to consumption growth seems to be pretty clear. All right, so yeah, so there were some questions about theory. I don't know if you guys allow me, or I'll have to skip because I'm at minute 46.
Yeah, you can go to go all the way to like
Okay.
750, I guess.
So one way to interpret this evidence, again, we don't have an equilibrium model, but it's customary in this literature to write down an affine discount factor and kind of trying to think about results in the context of an affine model. So here we can do the same, right? So if I think about, so I'm switching here to logs again, because that's typically how people write these models. And again, I'm thinking about innovation in SDF. And this is a dollar-denominated SDF. So it's going to be, again, proportional to these priced factors. And then for country I, we're looking at depreciation rate relative to the dollar, again, innovations. So there's going to be some exposure to F, unpriced factors, and country-specific factors. So now we can switch perspective and express the SDF in terms of foreign currency. So then it's just going to be dollar-denominated minus delta S. And so we will have this unpriced factor showing up in SDF. And that's why many people are saying, well, how is this possible that you have so much unpriced risk? Because if you change the perspective, then this risk should be priced. Okay, so let's think through this, right? So this stuff is going to be not greater than 10%, because typically the volatility of the whole exchange rate is about 10%, more or less, right? So even if I ignore contribution of F, this cannot be greater than 10% as a typical, as a sort of ballpark computation, okay? So it means that when I'm changing the numerator and I'm going from dollars to a foreign currency and I'm adding these guys, the maximal Sharpe ratio cannot be changed by more than 0.1%, by 0.1, not 0.1%, 0.1. Okay, so this is a very small change in the variance of SDF, because our, like I showed you, it's 1.3. Our maximal Sharpe ratio is 1.3. So the fact that we can changing this by 0.1 is tiny. In fact, you need about 400 years of data to detect this difference, right? So yes, this unpriced factors do show up if you change perspective of the currency, but this effect is just tiny. Okay, so it's kind of hard to detect. And so the other thing is like another way to think about portfolios. Now we're saying, okay, portfolios contain a big chunk of unpriced risk. Again, what I'm going to do is I'm going to say, okay, I'll take each individual currency and form portfolios with some generic weights W or omega. And so I can rewrite this basically. We assume that we have sufficiently large cross-section so that currency-specific risk cannot drop out. And so then we have some exposure to the priced factors. And then we have some exposure here to the unpriced factors. Okay. So basically what our results are saying, that the variance of this part, of the ratio of the variance of this part to the overall variation is 0.7. So this is just kind of empirical observation. There is nothing, maybe the magnitude is shocking, but I don't think it's contradictory to anything. All right, so let me conclude. So basically what we do is we construct out of sample UME portfolio that prices currency strategies. Okay, so basically what we're arguing is that theoretically optimal factor construction is feasible in the case of currencies. And so what we find is that emerging markets are important for kind of expansion of investment opportunity set, but in a subtle way. We need basically extra 12 floating emerging currencies in addition to G10 to price everything. And it means that, like, in terms of forming optimal portfolios and everything, we just need to focus on these currencies. And so we're basically capturing in this model, we're capturing these trends that we observe in the data. And also what we're trying to argue pretty forcefully is that existing factors are unsuitable for pricing because they contain a big amount of unpriced risks. And so if we just take original portfolios that people like and hedge out this unpriced risk will have a tremendous increase in Sharpe ratios. And so we feel like this hedged characteristic-based portfolio should serve as new benchmarks for evaluating of currency risk premiums and pricing models. And so this unpriced risk is related to geographic factors, and price risk is related to long-run consumption betas. All right, I'm looking forward to your discussion, Elias.
Thank you very much, Mike. Elias, welcome to share your slides.
Thanks. Perfect. Yes. So thanks for inviting me to discuss this excellent paper. So I really enjoyed reading it. So I will briefly, I realized I have too many slides for 5 minutes, but I will try to be quick here. So just to briefly summarize the paper. So as Mikhail showed earlier in the first figure, if we basically compute the cumulative return of the, for example, the carry trade strategy, and even works for other currency investment strategies, we see that especially for the universe of G10 currencies, especially after the global financial crisis, is actually flat. It levels off, right? And that's the main motivation of the paper. So they are like, okay, what is going to happen if we expand the universe of currencies? What is going to happen if we move to emerging markets? And actually, they find that's a striking part of the paper that actually for a broader set of currencies, especially those that are floating emerging market currencies, the carry trade strategy is very profitable. And and that's a key puzzle. So which currencies actually matter for this divergence? And a key finding of the paper is that standard factors, thinking in the context of Lustig et al. In RFS, are actually contaminated by large unpriced risk. And I think this is a key contribution, a strong contribution of the paper, because the first paper that basically pushes us a lot in order to think about unpriced risks in the foreign exchange market. And actually, they show that unpriced risks actually matter. So if you, for example, build a hedging portfolio that accounts for unpriced risk, the Sharpe ratios actually are much higher. So they asked this question, so can floating emerging currencies expand the investment universe? And can we disentangle price versus unpriced risks? So the key result of the paper is that if we consider floating emerging currencies, the Sharpe ratios go up from 1.2 to 1.34. And interestingly, managed regime currencies actually, so when they move from the 21 currencies to 59, they don't really matter much, so the additional set of currencies. So they actually highlight that unpriced risks are actually large. So that's another striking result. So they show that only 30% of the variation of the carry trade strategy is priced and 70% is unpriced, and it seems to matter. And as I mentioned earlier, it matters because once you consider a hedging strategy, the Sharpe ratios increase significantly, and also they provide an economic interpretation. So they show that unpriced risks are associated with geographical movements. So they built a strategy where you go short Europe and you go long the rest of the world, and they find that it actually matches their main pattern. And then price risk, in line with the literature, of course, is linked to the long-run US consumption growth. Interestingly, again, they highlight that dollar carry model actually fails both, and also they show results both conditionally and unconditionally. So of course, I want to highlight that, this is a very well-written paper. It has a very strong contribution to the literature. So this is a relatively new paper. So I think the authors later, they saw the economic mechanism of the paper, but I think later in the next version, I'm sure that they will actually go deeper, and that's my suggestion here, right? So the main result of the paper is that the GUMV, which has 21 currencies, price even a broader set of currencies, and they focus on as test assets on carry momentum and value, and economically managed regimes add no price risks. And of course, the authors show that this is associated with geographic factors. So my first recommendation is basically to go deeper, to understand why this happened, what is actually the mechanism. So would it be the case that it's because of the different regime types? So would it be the case that different peg bands mechanically transmit G10 plus G risk exposures? Could it be like a market integration story where capital control segment the GX markets, so make it information redundant, or as already the authors highlight, is more linked to gravity effects that are basically highlighted by Lustig and Roberts' papers. So my suggestion is to account for heterogeneity by regime. So consider rigid regimes as opposed to crawling regimes, and test what are the alphas in this for the different regimes. And then, because it could be the case that peg currencies just are pass through the risk that are already priced in G10 and G currency, and that's why you cannot find anything. I mean, there is no pricing associated with basically those currencies. And also, they could also link it more to capital controls. So we know that most managed regime currencies might have capital controls. So then it will be interesting to see whether more restricted currencies have larger alphas. Actually, in the appendix, the authors also consider alternative measures of market segmentation. So they look at the NDF versus the F, which could be like a good way to look at this. Secondly, there is a debate in the literature. Also, Mikhail actually highlighted this. There is a paper by Liu et al. Where they actually show, so in the literature so far, we know that dollar is not priced in the cross-section of currencies returns, right? So Liu et al., they actually show that, and that's unconditionally, right? And Liu et al., they show that once you consider a conditional model, then dollar and carry matters. But the current evidence in the paper shows that dollar and carry still leaves out a lot of risk unexplained, so the model failed. Actually, the authors show results both conditionally and unconditionally. So I think it would be interesting if they had a discussion about this in the paper so as to go deeper and explain why there is this nice debate in the literature. So I have some suggestions here. Could be that risk premia switches sign across states. So on average, it averages to zero unconditionally, but it's priced in different states. So it could be that the dollar is strengthens in crisis as opposed to calm periods. So one suggestion would be like to look at state dependence. So split the sample based on VIX or G-vol of Menkov et al. In JF, or whether the Europe versus the rest of the world factor have like different risk premia in different states, and this could actually give us a sense of what is happening conditionally. Another suggestion would be to focus on the maximal Sharpe ratio to understand whether the declining that it's illustrated in figure 10 is associated with lower risk premia of higher unpriced variance. So you can basically decompose the variance into price and unpriced so as to get a better sense regarding the conditional. So overall, my suggestion is, again, it's not clear to me what the difference is, but my suggestion is that this lower R square might be either because of unpriced risk, so as the authors highlight, it's geographic shocks, or it could be due to time varying loadings. Again, as I highlight, the authors show results for both conditional and unconditional. So yeah, so basically, maybe they could basically highlight this more, whether it's actually a zero risk premium, but in different states of the world, it's not actually zero. Next, of course, the authors also account for transaction costs. As Mikhail highlight, the bid and ask spreads are too wide. We know that from Lyons and also Menkov et al. In JFE and other papers. And that's why also Hayashi, we know that usually around 25 to 50% of the quoted spread is a reasonable transaction cost. So in a recent paper, in JFE, we also saw that price impact actually has a first order effect. So I think it might be interesting to use CLS data and also consider price impact in the measure. And finally, I have this idea, if you have access to CLS data as an alternative explanation, I mean, it's just out of curiosity, I want to know whether systematic difference in order flow between G and GX could actually explain the results. So for example, whether dealer balancing constraints bind differently across different groups, and this might explain the unpriced risk, whether it's unpriced to dealers and not investors. So that was a very interesting paper. I enjoyed reading it. It actually addresses a critical gap in the literature about the role of price and unpriced risks, and I look forward to reading the future draft. Thanks.
Thank you, Ilias. Mike, would you like to respond to the...
Yeah, thanks, Ilias, for the discussion. So I'll start with the last one. So of course, I know your paper, very nice paper. I think one immediate problem for your suggestion to look at order flow, right, is that I think CLS data has about 15 currencies.
Yeah.
I think it also has, but it includes both emerging and developed, right?
Yeah, but I think it doesn't have a lot of the currencies that we're looking at. So that's one problem with for us, because we were looking at your paper. That was one issue. Another issue with price impact is that, right, you don't know. I mean, obviously in your data, you know, given trade had the given size, right, and that allows you to estimate price impact. But from our perspective, when we're just thinking about generic thing, right, is that if we know the size of price impact, we would optimize on this. And so then the price impact, right? That's like what hedge funds are doing or whatever, right? They're trading so that their actual price impact is minimized. So it's very hard to say, although price impact, of course, exists, right? But if you optimize on this, it could be much smaller than one thinks, right? So that's what we're kind of grappling with, trying to figure out. That's why we said, okay, let's just do a whole bunch of different proportional costs. And then if there is price impact, it will kind of increase this. So it will fall somewhere, hopefully under 100%. But yeah, price impact is something, in principle, that's a very interesting question. Mechanism is key. We honestly were struggling with this, but we will think about your suggestions. Please send me your slides. We'll think about your suggestions for the mechanism. So Leo, at all paper. So I want to say two things. One is that, right, so what we show is that this characteristic-based portfolios, in particular dollar and carry, have humongous unpriced risk. So these portfolios are contaminated by unpriced risk. I feel like there is no debate about it. Again, maybe I have a biased opinion, but that's based on our results. You also mentioned R squared. So there's an important difference between alphas and R squares, right? Because the key for whether the model works or not, doesn't work, so to speak, if whether alpha is equal to 0 or not, right? R square is a separate thing. R square, yes, we interpret R square as a measure of the amount of price risk. And I agree that if you have some sort of notion of conditional R square, it could be moving around. So conditionally, the amount of price risk could be different. But that's a separate issue from whether alpha is equal to 0 or not, right? And so we're basically showing that we're using GRS test. They're also using GMM test. I'm not sure why, but they're using GMM test, which has much poor power properties than GRS. And that could be one of the reasons that they are failing to reject their model. That's it. Thank you.
Perfect. Thanks.
Thank you very much, Mike. So any questions from the audience? I do have a couple of questions. I think, Mike, you also had a paper in JF with Lars and Magnus pricing the currency risk for G10 currencies. That was also the UMVE. So in that paper, you mentioned that okay, the unpriced risk is related to this intermediary capital ratio, or like something related to the intermediary capital.
Yeah, well, it was in the context, right? So there's this paper, Kelly Manella, right? That they were saying in particular, right? They were saying that this measure of intermediation explains carry.
That's right.
And we're saying that actually it explains unpriced part of carry. So it's not related to the priced part of carry.
Do you see similar things when you extend it to GE or GEX?
No, we didn't, because we kind of took it into a different direction because, I mean, we didn't want to do the same thing that we did before. I mean, the methodology is obviously the same, but we kind of want to focus on this kind of interplay between emerging and non-emerging, whatever, developed countries, and wanted to kind of understand that aspect of the data.
I see.
And so we had to deal with transaction costs, all these things. So it's kind of, we took it into a different direction. Yeah.
I see. So another question is, so if we think about like currencies as an asset class, it could have price risk and price risk, but it could also have alpha. There's like anomalies. It could be very specific to one or two currencies. It could be like common to all currencies. It does not have to be like common variation across them. If we do MVE, we actually didn't know whether we are hedging out the unpriced risk or the price risk when the alpha is large, right? So if alpha is super large, we can hedge out price risk and still like earn that, right?
So what could have happened is that we constructed our measure of UMV and we rejected, right? There are significant alphas, right? So then of course, if we hedge it out or use it for hedging, there is no guarantee that we're capturing price on price component. It all hinges on the initial set of results that yes, our candidate UMV does price these portfolios, right? So that's a part that's not right. We have a theory which says that if you have correct mu and correct sigma, it will price. But
Right.
once you start estimating mu and sigma, there is no guarantee that it will actually happen, right? So that's
Right.
the first crucial part of our analysis, that yes, it does price this portfolio, so alphas are zero. So then when we hedge out this thing, what's left is unpriced.
So if I look at the correlation between the UMV portfolio returns versus these strategies, do they have like zero beta? Do they have like a beta of like, so what is the correlation between them?
Yeah, we're reporting them somewhere in the paper. Well, correlation is square root of R squared, right? So
So it's
for
like
dollar it's zero, for carry it's square root of 0.3, whatever
so
that is.
somehow they're hedging out all these like common like established factors.
Well, not somehow. It's a maximal Sharpe ratio portfolio. If it is the case, then that's what's going to happen. I mean, algebraically, it's very straightforward, right? The critical part is empirics, that, well, whatever you do actually delivers the goods. But conceptually, that's very simple. It's like very long stuff. It's like 70s, stuff from the 70s and early 80s, I guess.
So I was just thinking, if the currency as an asset class have a lot of alphas inside, but it also have price risk factors, but the price risk factor doesn't carry as large of a risk premium as the alphas, then is going to be beneficial to
Yeah,
hedge
but
out.
if there are alphas, it becomes confusing, right? Because if you have an alpha, right? So if you have some sort of a benchmark model which has an alpha, then it's immediately hard to understand what's
I
what,
see. Yeah,
right?
I
It
agree.
only works if you have a zero alpha.
I agree. And it's kind of amazing and bizarre to see like 70% on price risk in these carry strategies. Like why do we have to pay for like these unpriced risks to carry all these risks?
Well, so you have your paper with Nick where you have, right, your signal, you're looking at equities, you have a signal what on expected returns, you're sorting on
Right.
expected returns. You also have a massive unpriced component there.
That's right. But it's just I don't know, like because for the investors to get compensation, that was the basic Capan logic, right? You have to bear systematic risk. You have to
So
have
the
more
CAPM
compensation.
logic is that CAPM is the UMV. The market is the UMV. That's the CAPM logic.
But higher risk means higher return, right? But higher
Right.
systematic risk means
Right
higher.
system. Yeah. So UMV, right? So that's UMV.
But systematic risk means there could be common risk. We don't have to hedge out
No,
anything.
no. It's important to separate price and non-price, right? So when you're forming portfolios, you're getting rid of like whatever firm-specific or currency-specific risk, but there could be common risk that's not priced. And you find it in your work with Nick.
Yeah,
And
but I just have a
we
hard time like why it didn't enter the SDF if the
Yeah,
cap had.
well, yeah. So yeah, that's the mechanism question, right? How does it work that you have so much amount of common risk that's not priced? Yeah, that's what I'm saying. It's super interesting, right? We
Yeah.
wrote this survey with with Magnus and Lars. There is evidence across asset classes, both for equities, for currencies, what I showed you, and also there's work on sovereign bonds, which shows the same thing. There is a giant amount of unpriced risk everywhere.
Everywhere. Okay.
Yeah. So that's a challenge, I think, for us, how to think for us jointly as a profession, how do we think about this? So it's
Yeah.
very interesting. I don't have
It was the annual review of the financial economics paper, right?
yeah.
Yeah.
Yeah, so
Have to have
we have a
to
picture, we have a figure that shows across all asset classes, so you can see like in one figure, it's all basically the same thing.
Yeah, that was so bizarre to me. Yeah. Yeah, because we have this intermediary SDF saying something about like these all everything have been priced by one SDF. Now seems like we're turning around and say, okay, all these like co-movement is essentially unpriced. So
Well, not
doesn't
all,
mean yeah,
not all.
not a lot, but
A
many of
lot,
them.
a lot of it. Yeah, totally.
Yeah.
And so we have to go down this road. As a professional, we have to travel that road and figure it out. Yeah.
Yeah. Thank you very much, Mike, for answering all my questions. And Elias,
Well,
thank you for your discussion.
Thank you. Thanks, Elias, and thanks for inviting me and for your questions.
Yeah.
Thank you.
Thanks for the test as well.
Yeah. Thank you very much. All right. Have a good weekend.
Yeah,
Bye-bye.
you too.
Yeah.
Yeah.
Bye.